Welcome to the Bougie Black Brother Network. Good morning and welcome to M3 Millennial Money Management Info Podcast. So we're here talking about financial challenges that most millennials go through. And I'm here with my co-host Chaz. What's going on, brother?
Nothing much, man. Nothing much. Just happy to learn about this topic, actually, just because there's so much misinformation out. So I'm actually excited.
Yep, and brings us to our topic for today that a lot of millennials, baby boomers, and even toddlers don't even talk about, and it's death and insurance. So we decided to go through Marvel and DC and get us our own insurance superhero, and we ran into a gentleman named Jeremy Goodrich. Good morning, Jeremy.
Hey, good morning to you fellas. It's great to be on the show.
Excellent. So we wanted to reach out because we had one young millennial was like, why do I have to have insurance? I'm just working right now. I'll get insurance later on in life. And Chaz and I always talk about finance and money is not sexy unless you're at the strip club. And then it gets real sexy there. So we have our podcast kind of hitting in different ways of saying, hey, look, besides that, what are the things that we have to have do our life and, kind of prioritize? And in Jeremy, you have your own podcast as well, called, let me know what it is.
Yeah, Scratch Entrepreneur. So we essentially interview people who are business owners like yourselves and just let them share their story in our podcast.
Which is fantastic. I listened to two of them, and I'm want to get into some things that I can say, well, maybe I can do that. So Scratch Entrepreneur. I got to listen to the Canadian one, I think. What is it? Almost Canadian or something?
Yeah, there's a couple. I mean, there's How I Built This is probably the most famous podcast on the same basic topic, like letting entrepreneurs tell their story, and I think they do an amazing job of it. Obviously, Almost Canadian, I don't think I know that one.
Well, it's the last one that popped up on mine. But
Secretly Canadian, the episode of Scratch Entrepreneur that you're talking about. Yeah. I thought the best story from that was there's two brothers that are own this business together, and the two of them are, sometimes they have fights like all people who own businesses together do, and at some point they got into a wrestling match, and the younger brother finally beat the older brother for like the first time ever.
Right.
And he said it was one of the highest moments of his business ownership, which I'm not sure exactly what that says, but I think it's pretty cool.
Well, if you got an older brother, you'll know that. I went through that as well. Then my brother was like, don't you put your hands on me again. I was like, okay, no problem. I'm still the winner.
Exactly. Yeah, I'm the older brother, so I was always the one that won. So if I got taken down, I knew it was a different situation.
Absolutely. Sure. But we're here for insurance, and I'm gonna continue to call you either superhero or insurance guru because salesman sounds a little slimy. I don't really want to go with that.
Well, yeah. And I mean, I was an elementary school teacher for 13 years before my wife kind of talked me into coming over to this side. So I've always just looked at this as like I help teach people about stuff. And if they end up getting it from me, great. And if not, at least they know better than they did before, which is why I love being on your show today, just to kind of open up people's eyes, help people understand. And then, you all make the decisions you want to make about your finances and your insurance and all that kind of stuff.
Now, I'm curious, how did the teaching experience, did that help, or how did you transition from that to the current position?
Yeah. So, I mean, as far as philosophy, it didn't change at all, right? Like I used to teach 10-year-olds how to do not algebra necessarily, but, like division, right? Or how to write, how to be an author, or how to be an artist. I had a lot of different topics that I taught when I was a third and fourth grade teacher. When I came over to this side, again, now I'm just teaching insurance, and that's the only way I know how to approach it. And so as far as that switch, it wasn't different. I think the big thing that was different is when I was a teacher, I was just inherently trusted, right? People drop their kids off and they just trust you. And I appreciated that. And coming over to this side, you're inherently distrusted, like and so that was probably the biggest shift, was the perception of who I am.
Wow. Okay. That's very interesting. Okay.
So looking at that, because that is a great transition, because people need to be educated. So you on the line with two 10-year-olds and we want to buy insurance, but we have no idea why we need it, and we have no idea what the options are. So, but I'm happen to be a 10-year-old that's making a lot of money. So kind of walk me through that.
Well, that sounds good.
I may or may not be above the poverty line.
Yeah. Well, I think there's two sides, and I don't know which side you want to dig into further, but one is protecting your stuff, right? So like insurance for if you're a renter, or if you're a homeowner, or if you have a car, like insurance for your stuff, or if you have a business. The other is life insurance, and that's really a part of your financial planning, and I think that's the direction you want to go. I'm happy to talk whatever direction you want to talk, as far as what people should consider, what levels of insurance. All insurance has kind of the introductory level, how you start, and then understanding further how far you want to take it. It's all about what do I want as far as peace of mind. How do I want to feel if something bad happens? Do I want to spend a bunch of money to have the best insurance in the world, so if something bad happens, I know I'm overprotected? Or do I want to really skim, and not spend as much money on the policy itself, but know if something bad happens that I might be in a little bit of trouble as far as what kind of coverage I have?
So more so the life insurance. And let me give you a couple of scenarios, because Chaz and I are always talking with a couple of millennials, and they're looking more in investment.
Right.
But they're not looking at how to protect their investments, and who does it go to? You know what I mean? In this day and age, you don't know what's going to happen when, and politically, we don't know what's going to happen and when. So we really have to be prepared for that, and we really had a problem of how to introduce that.
Well, let's do it like this. So I'm thinking from my perspective. Let's say someone walks into your office, Jeremy, and say, hey, I just graduated from college, or just got this job, whatever the case. Why? I see you have all these insurance products, these different options. First, on a basic level, they may ask, what is insurance, other than obviously there's auto. We already know about that. There's health insurance, which we get through our jobs. What are the other insurance types, and then why should I get them? This is someone under 30. What will your response be to them?
So, especially when it comes to life insurance, the basic premise is you're going to pay a small amount of money a month and agree with an insurance company that if something bad happens to you, if you pass away, somebody is going to get a chunk of money. And the reason for that is it could be as basic as to pay your funeral expenses. Funerals can be $10,000, $15,000. And so if you've got a very simple life insurance policy that does nothing else but pay $15,000 so you can have a nice funeral, that may be where you want to start. But as you're coming out of college, it may not be as connected with where you're at right now, but it's likely, you might get married at some point. You might have kids at some point. You might have a mortgage at some point. And all those things could be a burden if you were to pass away to whoever you leave behind. So generally it's a spouse, right? And if you're if your income, what you're bringing into the family, disappears, then now your spouse has to handle any credit card debt you have. Your spouse has to handle the mortgage, and obviously that person's grieving too. They just lost you. And so to put that kind of weight on your family as you grow into it, is what you're avoiding by having the most basic kind of life insurance, just a term. It's called term life, and I'm happy to break it down. There's really two parts of it. But that's what you're thinking about. When you're younger, it's the cheapest to get. So term life insurance, it has two parts. One is how much money it pays out if you were to die. That's called the death benefit. The other part is the term, which is the amount of time that the price will stay the same. And the younger you are, the cheaper the price. So let's say you're 22 years old and you just got out of college. You could get $100,000 death benefit. So if you were to pass away, $100,000 would pay out to whoever you decide to get it. And you made a 30-year term. That's the longest term you can get. That could be $10 a month, and it will stay $10 a month for 30 years. The insurance company is not allowed to change the amount of money you pay per month until the end of that 30 years. So if you're 22, you're going to be paying that $10 or whatever. It's very inexpensive, all the way through the age of 52. And that's the beauty of getting life insurance young, is that the price is less expensive. As you get older, I'm 41 years old, so it's going to be more expensive for me to get the same life insurance policy than it is for someone who's 22.
Okay. Now, question. One thing that popped up to me is, and again, I'm hearing information. I don't know how true it is, but is what you're describing the same policy to where, like, are you paying into something? Or are you paying the insurance company? Like, what is there a policy to where it's actual like a fund,
right,
or something like that?
Yeah. So there's really three types of insurance of life insurance policies. The first one is a term life policy, which I just kind of described. And in that scenario, you are just paying the insurance company. You're paying that $10 a month. You're not going to get any money back on that. The only thing you get for that is, if you're to pass away, the death benefit, whatever that amount is, would get paid to, whoever you set as the person get it paid to. So if you have a $100,000 term life policy and you pass away, $100,000 is going to pay out. Otherwise, there's no investment value there. There's no additional value beyond that death benefit to the term life policy. What you bring up is, and I don't know if I'm going too far, stop me if you want to jump in.
No, keep going.
Okay, cool. Is two other kinds of life insurance that are called either universal or whole life. And so those have two parts to them. One is the death benefit I'm talking about. All life insurance has a death benefit, just like term life does. But the other is, it's kind of an investment vehicle. So now we're shifting into almost financial investing, where the life insurance company says, look, we're going to charge $100 a month, and 10 of that is going to be for the death benefit. So you don't get anything back for that. But 90 of it is you investing into a fund, which will accrue interest. It's a very low interest, usually 2 or 3% at the highest, but it accrues some interest. And you don't lose the value on that even if the stock market falls. So whereas investing in index funds or other kinds of investment vehicles, like I'm sure you guys talk about, you can lose money in the same way you can make money. If you invest in a life insurance policy, there's some protection there. You're not going to lose any money. It's a locked value investment. So it's lower interest, so it's not necessarily going to grow a lot, but it's a little safer than index funds, the stock market, all those other conversations.
So Jeremy, real quick, the question is, we have a lot of millennials who jump in and out of jobs.
Yeah.
There's insurance on the job that they pay 2 times your salary, and sometimes they get that. But if they jump out of another job and getting into another one, but we're looking at this constant. So for millennials who jump in and out of jobs to say, where's my next advantage? How do I stay constant with something like a term, a whole, or universal? Because a lot of times when you transition to somewhere else, a lot of things get dropped off when you're either unemployed or when you're just moving on, because you don't even think about the insurance. And if you take a step down, which is a problem, you start saying, I don't need dental right now. I'll hold out on that insurance because I need as much money as possible. How do you approach that?
I think there's 2 thoughts I have. One, when you get that job, when they show you the package they're providing, one question is, how does this work once I leave? That's a weird question to ask when you're in the first days of a job.
I know when you first
yeah, because
no, that's a great question, because I'm dealing with that now.
Yeah,
I'm trying to figure out how to get my retirement money.
Yeah, right. Yeah, and so answering those questions for yourself at the beginning, which any human resources department should be willing to do, because a lot of these life insurance policies that you get through work, they will continue if you leave the job. Now, most of the time, your employer will pay the premium in while you work for them. But then if you leave, you have to pay the premium. Like, they're not going to keep paying the premium. But a lot of times you can keep them. So if that's the case, then that may be plenty of life insurance for you. And if you leave or you end up, in whatever your next situation is, you can take that policy with you. Usually what I see is that's the case. But the problem is, the death benefit is really low. Although, Chaz, you just said, 2 times your annual salary, which is a lot higher than I tend to see. Usually I see like $20,000-$25,000 life insurance policies, which is really nice of your, employer to provide. That's great. But I'm not sure it's the type of life insurance policy that's really going to take care of you over the course of time. I would say you'd need a better policy outside of your employer in that case.
And I think you made a great point too. It depends on your circumstances. If you're married, and you say, well, my wife is not going to work. We're going to have children. So you have to take in consideration what she's going to need if you're not there. So 25,000 is not going to damn do anything. Especially if you have a home or you have a lot of expenses that you do on a monthly basis. 25,000 will probably last for a couple of months and then you're done. So not good. But if you do something within a couple of 100,000, it can pay off a lot of things and set them up to move on to other stuff. So I like the universal, and that's really where Chaz and I really talk about investment and wise, and it's more attractive, especially when you're younger, to say, not only am I saving for my life insurance, but I have a separate vehicle within that to say, hey, and I'm investing money. It may not be tremendous on the stock market, but it's not going to waste. You know what I mean? None of that is going to waste. So that makes it really. Go ahead.
And that's why I wanted to circle back to the other insurance, because I think, like, just for me personally, I pay my auto insurance because I have to. There's no way around that. I have some renter's insurance just really because it's cheap and it's just, for the just in case. But for life insurance, without the investment piece, without feeling like I can, there's some financial cash or some liquid value, just for me, $10 a month isn't a lot, or however much it would be. But I still like the idea of a life insurance policy that has some sort of financial cash value.
Yep. Mm-hmm.
So it's kind of like it's the feeling of, okay, I have some sort of asset here. Obviously, it's for a certain purpose, but just for me personally, I like that idea better than the other, like the term life insurance, for example?
Yeah, I think the way I like to look at it is basically like this. So if someone's looking at life insurance, I can get them a proposal for term life, which has no financial value for you besides the death benefit, and universal, which has the investment value there. And let's say the term life is that $10 a month that we've been using as an example, and the universal is $50 a month. And that's about what I see in the difference generally between the two. The question that I think you ask is that $40 a month different. What are the ways I could invest that would make sense?
Right.
One is life insurance, and I'm obviously not hating on that or anything like that. It's certainly a good idea. You put the $40 in, and you have that, and you get it back. It's safe. It's going to grow a little bit. But if I'm younger, I wonder what other things I could do with that $40. And to me, that's where a financial advisor comes in a little bit more. If you can sit down with one and say, well,
right.
what are my options for that $40 a month? Life insurance is one option, universal life, but another would be maybe index funds or something like that. What's most likely to give me something in the end that has the best value for me? That could be universal insurance, life insurance. It could be a mix. If that $40 is all you have to invest, I'm not sure a universal policy is the best option. I'd probably go with the term life and pay the $10 and put that $40 somewhere else. Right. But if you're,
I see. Okay.
If you got $200 a month that you can invest, now you can change that conversation. All right, well, let's put $40 into a universal life policy, and let's put 160 over into an index fund or something that's going to grow a lot faster than life insurance. So obviously it depends on your scenario. I love working with financial advisors because I think that they can see the whole picture for folks. But when you're young and you don't have a bunch of assets, I tend to think at least get that term policy, spend that $10 a month. If you can do the extra $40, the question is, where should you put that? To me, it might be an index fund over your universal life policy. Right. That's really kind of up to you,
Okay. It makes a lot of sense, actually.
My only reason is the discipline factor. A lot of times, millennials is like, yeah, I'm investing. Oh man, I'm losing money. Let me pull my money out. Whereby if you're using the universal, you can always say, oh, that's growing. And when I'm doing it, it's growing. And then when I get older to understand that the stock market isn't a day-to-day thing, it's a long-term investment, and you're going to see highs and lows. That discipline factor goes with more maturity as opposed to quick satisfaction to this day and age. Is like, I need to be feeling good about, hey, I'm in cryptocurrency, it went down 60%, oh my god, let me put my money. No, hold on, things are changing. These are long-term investments. But I really like how you said it. It's like you can use that $40 somewhere else. You don't have to start investing in something that is 1% to 2%. You can put $40 in something that can grow a lot better. Or on the other hand, let's have that as an addition, because if you got $160, then you can put that in the true growth. Good options though. And so thank you for that. But I'm really was concerned with the discipline factor with, if a financial advisor say, nope, this will give you maybe 8% this year, and we already looked at a couple of these indexes, and let's just go with mutual funds or money market right here, as opposed to buying Netflix, and that's dropping next week or something like that. So that's really interesting to have as an option. So that was something a little more clearer. So thank you for that.
Yeah, absolutely. I think that it's all about, where you're at, and you're right. If you don't have the discipline and you're, $40 is going to do a lot better in a universal life policy than it's going to do, at a ball game or some other place where you're just spending it and it's gone. But I think if you do have the discipline, there may be better places to start with those lower investment amounts and then bring it up to the universal life policy or something like that as you have more to invest. I don't know. There's a lot of different ways to look at it.
Okay.
That's just one.
So let's go back to one of the first things you said, which, being young and you're single and you don't have anything to worry about. I did a package to say, if you die today, the average price of burying you on the low end is about $11,000. So if you get an insurance policy to say, I don't need to leave money to anybody. All I need to do is make sure they don't have to pay for my burial costs. My burial cost is this. That's all I need. So that's the only thing that I'm going to be saving up for. That's a option that I guess we can approach in that way to say, do you only care about being buried and not being a burden on anyone else? Or are you really looking at your situation and say, I got family, or, I need to take care of my mom when I die, or my family, or whoever? How do I look at these things? So I think that's important. That's why I kind of broke that down to, $11,000. That's a lot. Funeral transportation, viewing and ceremony, embalming, transfer of the remains. I'm getting a little morbid. I'm sorry. Professional services. I mean, there's so much that's there, and it adds up quickly. And then there's like, but I want my loved one to go out in style. So that style will cost you a lot more than $11,000. So that's something really important to be thinking about, especially a young millennial who has no, family ties to a spouse or children or anything in that manner.
Yeah, I mean, I think it's so simple, especially these term life policies. If $5 a month is as low as I've seen, if you're in your 20s and you just want even a $50,000 term life policy, like $5 to $8 a month, and you set it up on automatic withdrawal on your account, and you're done with it. And then even if you make your mom the beneficiary or your dad, then, in the case of something bad happening, that the burial costs are covered. Maybe some of your student loans are covered. And, that's, if nothing else, at least you didn't put that burden on your parents. But I think taking another step up, making it 100,000 or 200,000, especially when you're early 20s, the biggest reason to do that is because that's when those policies are the cheapest. And so you can, lock in that $200,000 policy, and at a $10, $12 a month rate, and you'll have that for the next 30 years, as your life changes and evolves.
Stay tuned for our next episode of M3 Millennial Money Management, when we finish our conversation with Jeremy Goodrich about insurance policies, not just life, but different other types of policies. On the Bougie Black Brother Network.